$1 invested in U.S. stocks in the 1800s is worth $3.6 million today. That's a lot of cash, right? But wait a minute. Who has 200 plus years to wait for their money to grow? Not you, not me, not even Ben Franklin and his Invest to Give plan. We want our money to grow faster, right? Well, what if I told you there's a way to make even more money in much less time? In this video, we'll analyze SCHD's investment strategy, portfolio composition, and performance, and show you the 7 facts that make it stand out for long-term investment. In the end, we'll show you how you can turn $100,000 into $6 million with SCHD without waiting for centuries. So let's get going. Quick recap for those who are new. Exchange-traded funds, or ETFs, are essentially low-cost funds listed in the stock market which you can buy and sell just like stocks. Simply put, ETFs are funds that track the performance of a basket of stocks, bonds, or commodities. Likewise, dividend ETFs are ETFs that track a basket of dividend-paying assets, such as stocks and bonds. Dividend ETFs make it easy for investors to gain diversified exposure to a basket of dividend-paying stocks without having to pick individual stocks. And the diversified nature of ETFs significantly reduces the impact should a single company perform badly. One of those ETFs is the Schwab U.S. Dividend Equity ETF, sponsored by Charles Schwab. It was launched in 2011 and is a passively managed exchange-traded fund designed to offer broad exposure to the large-cap value segment of the U.S. equity market. With assets totaling over $52 billion, it ranks as one of the largest ETFs attempting to match the large-cap value segment of the U.S. equity market. To top it off, it has a low expense ratio of only 0.6%. SCHD has 102 holdings. Its top 10 holdings make up 41.84% of the fund. Stocks are filtered based on 3 criteria. The stock has a minimum of 10 consecutive years of dividend payments. The minimum float-adjusted market cap of the company should be $500 million. The minimum 3-month average daily volume of trading should be $2 million. Then the qualified stocks are further ranked as per the dividend yield, 5-year dividend growth rate, company's financial health, and return on equity. As a result, companies that are qualified and have higher weighting in SCHD holdings are usually companies with strong financial health and have a solid track record of dividend payout. You might think that with such strict requirements, they should easily top the charts every year, but let me be clear, the Schwab ETF had a bad year last year. Before you go making rash decisions and panic sell, let's talk about recency bias and prospect theory. If those terms sound alien to you, it's about time we learn some basic behavioral economics. Recency bias, as the name suggests, is the human tendency to think that recent events are more important than they actually are and will continue into the future. It's the financial equivalent of seeing one cloudy day and concluding that the sun is never going to shine again. Then there's prospect theory, which says that people feel the pain of losses more acutely than the joy of equivalent gains. So, a 7.36% drop in SCHD last year probably feels like a kick in the teeth, especially if you hopped on the train in 2022 when it merely dropped by 3.23%. This instinctive knee-jerk reaction is why many investors end up buying when prices are high and selling when they're low. The result? Their overall returns are often worse than the funds they're invested in. But here are some facts about SCHD that'll make you bullish on it as a long-term buy-and-hold dividend strategy. Fact number 1. It's cheap for what you get. When it comes to ETF investing, costs can make or break your long-term returns. One of the standout features of this ETF is its incredibly low expense ratio of 0.06%. To put that in perspective, for a $10,000 investment in this ETF, you would only pay $6 annually in fees. So what do you get for such a low fee? Because of an extremely precise, unique, and robust index methodology, as I said, the ETF begins its selection by identifying companies that have consistently paid dividends for a minimum of 10 years. This in itself speaks to the stability and commitment of these companies. Additionally, only companies with a float-adjusted market cap of $500 million or more make the cut, making sure you're not investing in the unpredictable world of microcaps. And for liquidity, an average daily traded volume of $2 million is the benchmark, guaranteeing ease of trade. Once companies pass the initial screen, they're then ranked by their indicated annual dividend, or the IAD yield. This makes sure that the ETF is zeroing in on those businesses providing the best dividend returns. But SCHD goes even further. It carefully looks at companies using 4 important factors: how much cash they have compared to their debts, how much profit they make compared to the money they've invested, the amount of income they generate from their dividends, and how fast their dividends have been growing for the past 5 years. By considering these factors, the ETF ensures a blend of company stability, profitability, and dedication to increasing its dividends. By giving each of the 4 factors the same importance, it combines them to create a single score. This score helps choose the best 100 stocks to include in the index. Now, let's talk about what's actually in the ETF. When you invest in SCHD, you're putting your money into 100 big American companies that pay dividends and are considered both valuable and high quality. Just to give you a quick look, some of these companies are well-known names like AbbVie, Chevron, PepsiCo, Pfizer, Coca-Cola, Verizon, and Texas Instruments. They're giants in their industries, which means they are reliable and have the potential to pay good dividends. The question is, with such good names, why did they stumble in the last year? Well, it might not be SCHD's fault. In 2023, something very unusual happened. People started to invest a lot in what we call risky stocks. These are companies that don't make much money and take big chances with their investments. Surprisingly, these risky stocks did better than safe and strong investments. It's like 2023 became a place for people to take big risks with their money. Even though interest rates were high and prices were going up, investors still went for those riskier bets. Unfortunately, this kind of situation isn't good for an ETF like SCHD, which normally does well with safe and strong big companies. The past few years might have been tough for the ETF, but know that it has recession-resistant holdings. SCHD has made changes in the companies it invests in over time. Recently, it has been buying shares of companies that tend to do well even when the economy's not going so great. Companies like Merck & Company, PepsiCo, and Coca-Cola are examples of such companies. Merck makes medicines for both people and animals, and during tough economic times, people still buy these important medicines, so Merck doesn't suffer much. Amgen and Pfizer are also pharmaceutical companies, and they have similar characteristics. Coca-Cola and Pepsi are known for their drinks and snacks, and even when things are tough, people usually keep buying their favorite drinks and snacks. So when you look at the top 10 companies that make up a big part of the ETF's investments, about 42%, they all seem to be businesses that stay strong even during tough economic times. People still buy their products even when money is tight. And it's not recession. The holdings are inflation resistant. Many of the big companies that SCHD invests in are not only strong in tough times, but also when prices are going up, which is called inflation. For example, Pepsi did really well in its recent financial report because it could control its costs and increase the prices of its products by 12%. Coca-Cola can also do this because they're one of the top companies in the beverage industry. The healthcare companies that the ETF invests in can also raise their prices when needed because people will pay for essential healthcare products no matter the cost. Even though the top 10 companies in SCHD's investments don't include financial companies, the biggest part of its investments is in the financial sector. These financial companies often make money by charging a percentage of the transactions they handle. so they should do well when prices are going up, which is what happens during inflation. Now to fact number 5. SCHD is virtually risk-free in the long term. Warren Buffett defines risk as the probability of losing all your money. What is the fundamental risk to U.S. Treasury bonds? According to S&P, there's a 0.29% chance the U.S. will default on its bonds in the next 30 years. What about SCHD? What's the risk of that going to zero? For that, look at the ETF's top 10 holdings, which comprise 40% of the portfolio. Now, tell me how likely is it that all 10 companies will go bankrupt and their stocks plummet to zero? How about all 100 companies the SCHD owns? The odds are close to zero. How close? According to Goldman Sachs, the risk of a nuclear war with Russia taking the S&P to zero is 2.5%. That is why all ETFs thus have an A- stable effective credit rating, because there's a 1 in 40 chance that nuclear war will make the stocks worth nothing. But listen, if that happens, let's be honest, stocks won't matter. I should point out that in the event of a nuclear war, the U.S. government is gone and U.S. bonds are worthless. However, over the long term, the ETF isn't capable of becoming worthless. Okay, but maybe you think U.S. Treasury bills income is rock solid and SCHD's dividends are higher risk. So let's dive into fact number 6. SCHD's dividends are not high risk. SCHD has been giving more money to its investors every year since it started. Why is this money safe? It's because the ETF follows a strategy that makes sure the investments are safe and of good quality. They also pay attention to how much the investments are worth and manage any risks carefully. If you look at the list of companies that the ETF invests in, you'll notice that they have a history of increasing their dividends for more than 10 years. This means these companies are planning to stay around for a long time and continue to give money back to their investors. In the last year, SCHD has given $2.62 for each share you own as a dividend, and its return is 3.8%, which is even better than many other investments that focus on giving high rewards. What's more, the ETF has increased its dividend payment every year for 11 years in a row. On average, over the past 5 years, the dividend has grown by 13% every year. This shows that the fund is committed to giving more back to its investors over time. So, the ETF takes the same focus on income dependability that Ben Graham loved, and then adds some quality, safety, and value screens. And speaking of income, don't forget about taxes. Fact number 7. SCHD's dividends have a better tax treatment. When you earn money from bonds, the government treats it like your regular income and taxes it accordingly. But when you get dividends from SCHD, they consider it as money you made from investing for a long time, and they tax it at a lower rate, usually around 15% for most people. Now here's the important part. The average American pays taxes at a rate of about 24.8%, which is higher than the 15% tax rate on SCHD's dividends. So for most people, the ETF is a better choice because it means you'll pay less in taxes on the money you earn from your investments. You can also legally avoid paying any taxes on your investments by using tax relief accounts like 401k and Roth IRA. Let's see what happens if John puts $100,000 into this ETF and uses a plan where he reinvests the dividends. The ETF gives him a 3.47% return in dividends, and on average, it grows by 10.83% each year. Plus, it has increased its dividends by 11.39% every year for the past 10 years. So in the first year, John's money will become $114,300, and he'll get $3,470 in dividends. Not bad, right? But there's more to come. After 10 years, John's money will double to $195,422, and he'll get $6,063 in dividends every year, which is about $505 every month. That's enough to cover his Netflix subscription and some pizza. But the real compounding effect of SCHD starts here. After 20 years, John's money will reach $1,497,680, and he'll get $50,386 in dividends every year, or $4,199 every month. So John achieves his goal of becoming a millionaire in just 20 years, not 200 like some other investments. But John is curious. What if he leaves his money in SCHD for 30 years? Well, after 30 years, John's money will grow to $5,959,205, and he'll receive $211,589 in dividends every year, which is about $17,632 every month. In 30 years, he made $5,859,205, and most of it, $4,295,935, came from the growth of SCHD, while $1,563,270 came from the dividends. This is because this ETF is growth-focused, it's recession-resistant, and inflation-protected. If you want to invest in more ETFs like this one, check out our video on 6 Buy and Hold Forever Dividend ETFs.